for XRP over here, how would you separate that with the ripples itself?
So Ripple is really like a digital asset infrastructure for institutions, including banks, asset managers, including DLD. And we're doing that through the Ripple payment product, through XRP Ledger, through the RLUSD, so Ripple USD, and the custody. So we have those 4 products, and they are all using XRP.
And no unrealistic price targets here, no Fibonacci, Moonboy, outrageous bullcrap that swarms the market, just real authentic education and information. And I'm hoping that you guys are really paying attention so that way you can avoid all the retail manipulation that is out. Okay, so I want to make sure that we all really thoroughly understand and go over what took place today, what we are waiting for. One of the primary events that was set to take place this week has now been released, and that is the FOMC meeting in minutes. I do understand that there are still a lot of people in this community that are still going through their fundamental learning curve, and so they're truly trying to digest and understand these fundamentals and really involve themselves with this community that is institutionally based, right? We don't make any outrageous price projections. We stay in line with current and updated market fundamentals, and we give realistic and accurate target trajectories based off of institutional delta zones aligned with the current fundamental sentiment, whether it be risk on or risk off. And I want to show you guys today how our projections via our community call that took place days in advance on the 7th aligned with both delta zones and fundamentals that we were delivering. And then I want to really pick apart the FOMC meeting in minutes so that way you guys understand the FOMC meeting in minutes. I want to show you all, again, paying attention to detail, key vocabulary. I thoroughly went through and read this entire thing like I usually do. You guys don't have to. It would behoove you all to do so if you're learning fundamentals. It is quite extensive and it does take some time. However, I'm at a point in my career where this is like the 5th year that I've been reading these reports and these meeting in minutes. So I understand more thoroughly what I'm paying attention to so I can skim through them better. And so one key takeaway from today's Zoom call that I want you guys to leave with is kind of my mindset around what I look for in these reports that allow me to digest the market sentiment, paying attention to key highlights and key details, showing you guys how much fluff is in these releases, and then also picking apart the key important details. So we will go over my personal highlights from this. If you guys want to do this with me while we're going over this, you just go to, you can get this directly from the federalreserve.gov website, or you can go to Forex Factory, type in the US data, go to the recent release of the FOMC meeting in minutes, and then there will be a direct link there for you guys to open this up if you would like to. We're going to read through today's report that I typed out for you guys. I will make sure that I deliver this for you all in the Discord after the Zoom call. So let's jump in. First, starting with yesterday's report and taking a look back at July 7th's fundamental Zoom call, which was our last Zoom call where we delivered a technical analysis breakdown. Thorough. We went in, we took a look at fundamentals in the landscape back on July 7th, which was Monday. We delivered our overall trajectory of the market where we projected that XRP, Bitcoin, and the total cryptocurrency market cap's price action was going to go. And I want to show you guys how some of the things that we were talking about then now align with current fundamentals today, and how that also aligns with price appreciation on these assets. Nothing substantial or out of the norm, but definitely seeing some gains across the board. As of time of recording, the total cryptocurrency market cap's trading at about 3.37 trillion, up about 1.35% on the day. No unrealistic price targets here, no Fibonacci, Moonboy, outrageous bullcrap that swarms the market, just real authentic education and information. And I'm hoping that you guys are really paying attention so that way you can avoid all the retail manipulation that is out there. So starting here, this was our July 8th report. So this was yesterday's report, where down here at the bottom of our reports, we always discuss and talk about what we would ideally like to see the next day to paint a risk-on environment to see appreciation in our portfolios, and inversely, what could do the opposite what environment could be created that would create a risk off scenario. And so paying attention down here at the bottom, the two things that we identified here that we'd like to see today is we would like to see the FOMC meeting in minutes hint at the potential or possibility of rate cuts later on this year, or at least ease the concern over global uncertainty in tariffs leading to higher inflation. That is a very key highlight right there, because as we thoroughly go over the FOMC meeting in minutes today, you're going to see some of the highlights today and the four factors that I have written down here that played a significant role in leaning the FOMC meeting in minutes today more dovish than hawkish. The second thing that I want to take your attention to is I mentioned that we'd like to see soft US inflation expectations. So we'd like to see the market start to dial back elevated inflation expectations, or expectations that there still remain a lot of upside risk to inflation, or jobs data that gives the Fed more room to ease. Now, we haven't gotten the jobs data yet, but that is also something that we will be paying attention to tomorrow. So these are the two primaries that we're going to really digest, and you're going to see how today that is the exact environment that was painted. And so in July 7th Zoom call, as always, I like to give you guys timestamps, realistic and accurate price analytics. No, indicators on my charts, no nothing. I only use deltas, and I only use them and combine with fundamentals to paint the risk on or risk off environment. Okay. So here's the Zoom call from July 7th. You can see I always like to give timestamps. Most influencers and people on the internet don't. They can't back what it is that they're saying. You can see we did a detailed analysis where I pretty much mentioned to you guys two scenarios were likely to play out. Either a dip down into previous weekly lows and a bullish recovery in a risk on market environment, or some slight consolidation and a breakout move to head back towards previous weekly highs would be scenario number two. If we head over to the total cryptocurrency market cap, I have not deleted any of my drawings, and literally pip for pip, you can see that scenario number two that we discussed on the Zoom call 2 days in advance has now fully come into fruition, right? Where the market slightly consolidated. In that previous Zoom call, I had mentioned that we were paying attention to these higher lows, and as long as they held, the path of least resistance was most likely skewed to the upside, and we were most likely going to start to fill some of the imbalances in these candlesticks up here, or where previous premium sellers existed, as buyers would most likely make another attempt to attack sellers or surpass sell pressure in the market. And that is exactly what is happening today. If we go and we look at our XRP analysis, same thing. You see $15 price projections on XRP, $10,000 price projections on XRP. Yet here in this community, we take things level by level, and accuracy stands in our corner. And so here is our July 7th XRP analysis, where we had annotated that we need to break above roughly about $2.36 to $2.43 before we can see higher price levels on XRP. These were the two scenarios that we had identified. The first one was a slight retracement down into $2.17 and a bullish recovery, or consolidation and a breakout above $2.36 and a bullish move towards $2.53 to $2.63. You can see I have not deleted any of my drawings on XRP, and that same exact scenario number two is now fully coming into fruition. All right. So nothing outrageous. The fundamentals that we delivered days in advance, the technical analysis that we delivered days in advance is now fully materializing. Let's break that down. So if you guys did not read yesterday's report, this report detailistically talked about why the tariff implications and all the updates on tariffs did not have a negative impact on the market sentiment. I suggest that you guys go back and read this if you did not. We talked about the tariff turbulence. We talked about the recent announcements between multiple different jurisdictions and how the market was kind of shrugging off, in a sense, the tariff uncertainty. And today's FOMC meeting in minutes kind of solidified that. So today, looking at this report, July 9th afternoon report, the markets responded positively to this week. Sorry, excuse me, let me restart that. The markets responded positively this week following the latest round of tariff updates and the release of the June FOMC meeting in minutes. On Tuesday, White House economic advisors Stephen Moran, so this was yesterday, downplayed inflationary concerns tied to tariffs. Hint, hint, right? I'll highlight that in bold, because if we look at yesterday's report, what did we say needed to happen? Right? We needed to see the markets, right down here, we needed to see the markets price in softer inflation expectations. And that is exactly what we got. We got a White House representative and we got some Federal Reserve representatives today in the FOMC meeting in minutes downplay inflationary concerns. Here is that report right here. It says White House odds of tariff-related inflation are low, like pandemics or meteors. This is directly from this gentleman here, White House representative. To continue this, it says, likening the chance of significant price surges to a meteoric striking Earth, his point, there is no clear evidence yet that tariffs are feeding into consumer prices in a meaningful way. This connects with the FOMC's own assessment, where most members expect any inflation from tariffs to be modest or short-lived, with businesses likely to delay or absorb price hikes. The newly released FOMC minutes reinforce the Fed's wait-and-see approach. While a few members remain open to cutting rates soon if the data softens, most still prefer more clarity before acting, but rate cuts for now are not off of the table. And this is just a little tiny report from Trading Economics where it talks about the US stock market gaining some ground. It was from about 5 hours ago when I took this screenshot, and you can see just a little tiny key vocabulary. It says markets continue to bet on 225 basis point cuts until the end of the year. Along with that, markets are still pricing in the 25 basis point rate cuts. This patient stance, combined with the belief that tariff risks has peaked and that inflation expectations remain anchored, is supportive of risk assets in the short term. I highlighted that in bold in the short term because we have to remember that 95% of activity in these markets is still primarily driven by trading. So that means XRP's price and all these other digital assets right now are appreciating in value, not because the utility lights have turned on, which means that tomorrow the sentiment and the landscape could completely shift if the fundamental headlines change. And that's something that as a community, we clearly understand here. And I'm hoping that you guys are really starting to grasp. So don't marry a bias and be reactive if the market conditions change. So as of now, the total cryptocurrency market cap is trading higher at 3.37 trillion, up around $36 billion on the day, or at time of recording this video and when I screenshotted the market. There are also no fresh geopolitical risk-off headlines, and tensions in the Middle East appear to be moving toward diplomacy. Iranian foreign minister, I'm not going to butcher this gentleman's name, and U.S. officials have traded comments recently, hinting at a possible path toward renewed negotiations, which is always usually supportive of risk assets. Aragachi also met, I don't know who this gentleman is, Aragachi, met with Saudi Crown Prince Mohammed bin Salman, marking the first such engagement since tensions with Israel escalated. So that is clearly a very positive sentiment right there. Here is a little tiny screenshot where it does mention that the US may be open to renewed diplomacy, and it talks about that meeting that took place yesterday. So to finish this off, while these developments do offer some relief, traders should not get complacent. Key risks still remain ahead. Tomorrow, we have Thursday's U.S. unemployment data, and Friday, we have multiple different Fed speakers scattered throughout the day that could recalibrate the current expectations. Any escalation in trade tensions or failure to secure new agreements ahead of the August 1st tariff deadline could quickly sour the market sentiment. So here you guys have a checklist, what would be positive for risk assets moving forward throughout the remainder of this week and into the weekend, and what would be negative. So to cover those briefly, I talked about the FOMC meeting in minutes already today, so we'll go over that here in just a second. Any tariff-induced inflation seen as temporary or modest continuing. So tomorrow we have Fed speakers. If they continue to reiterate some of the things that were mentioned in the FOMC meeting that I'm going to go over today, that's going to be supportive of risk assets. Peak tariff risks likely behind us. So any headlines or any comments from any officials that say that, tariff risks are likely behind us, they peaked back in April, which we'll again cover here in just a second. Anything that supports that tariff uncertainty, and the vast majority of it is relatively behind us. Any inflation expectations remaining well anchored. So moving forward, if we get any inflationary reports or we get any comments on the inflation outlook from Federal Reserve speakers, and they mention that the expectations of inflation risks to the upside are well anchored, or non-existent, that would be positive for risk assets. No fresh geopolitical escalations, any signs of renewed US-Iran diplomacy, or any fresh ceasefire talks or headlines that announce that Russia and Ukraine or anybody in the Middle East is coming to cahoots with each other. Solid labor market data and consumer spending. Okay. Tomorrow we do have the labor market figures, which are projected to come out slightly positive or more positive than the market had previously shown figures. So the figures are set to come out and show a slight strengthening in the labor market. Now, why could this be supportive for risk assets? Because it can show that the labor market is still healthy, which eases recessionary fears. Couple that with the recent expectations of lower inflation, that supports the soft landing narrative. All right. Now, if the labor market data comes out excessively upbeat tomorrow, that could weigh on the rate cut bets. So we do need to be mindful of that. And then also on the opposite side of that spectrum, if tomorrow's labor market data paints a very bleak picture on the unemployment outlook and it shows excessive cooling in the labor market, it could spark recessionary fears and could weigh on risk assets. So we need to see the data come out in that sweet spot. And then last but not least, any easing financial conditions, tighter credit spreads, lower volatility, so on and so forth. I won't read what's going to be negative for risk assets. We'll cover that in just a second. I want to really break down for you guys this FOMC meeting in minutes so that way you guys understand the rhetoric that was delivered from this report as to why we're seeing the total cryptocurrency market cap surpass previous weekly highs and we're not seeing a deterioration in market sentiment, right? So let's break that down. I have 4 primary factors that I personally gathered after reading this report that I paid the most attention to and that I believe are holding the most weight. Those 4 primary factors, and going over some key vocabulary, are number 1. I noticed that in this report, they mentioned not once, but twice that there has been an improvement in risk sentiment. Word for word, they specifically mentioned that vocabulary. We'll go over that in just one second. So that was number 1. Number 2, they mentioned multiple times that inflationary risks remain relatively low. Number 3, you can see in the rhetoric from multiple Fed speakers that there is a willingness and an openness to cut rates later this year, so the data shows or supports it. And then last but not least, number 4, tariff risks have declined. So a lot of the Fed speakers believe that the tariff risks peaked back in April and that the vast majority of risks due to tariff implications are behind us. So those are the 4 things that I gathered from today's report that support a more dovish leaning outlook, support rate cut bets, and keep risk assets more frugal and hopeful, as we can clearly see respected in the price action today. So starting at the top of this report, you can see that the first, I'd say like 20 paragraphs of this report are all just garbage, just a bunch of junk. You guys, again, when you're reading thoroughly through this, start to pay attention to key vocabulary words and start to think of when you're reading these really thick reports from Fed speakers, from central bankers, whatever the case may be, you're really just trying to pay attention to key vocabulary that supports risk on sentiment or weighs on risk sentiment. And that's it. Anything outside of that, like all these statistics and data and percentages and all that crap and opinions that are fluffed up into these reports, redact that stuff. If you have a highlighter tool, it's best to go through it with a highlighter tool so you can black it out and you can really focus on the things that matter. So the first thing that I highlighted in this report, it says here, a staff review of the financial situation. Let's zoom in a little bit. Says, despite a weakening of near-term inflationary pressures, the market implied paths of the Federal Reserve funds rate over the next year increased over the intermediate period, with improvements in the economic outlook amid a general easing in trade tensions. That is important right there, right? Easing in trade tensions. That's some good key vocabulary. Near-term inflation compensation declined. So anytime you see inflation and decline in the same sentence, that's usually bullish for risk assets. While longer-term inflation compensation was little changed. Nominal and real treasury yields increased moderately on net across the maturity spectrum. So that was the first thing that I highlighted. Lots of good key vocabulary word in there that's supportive of risk assets. The second thing, I was actually surprised to see this. It says right here, consistent with improving risk sentiment from recent trade developments, broad equity prices index increase markedly and credit spreads tightened. So that was the first key highlight. I put that in yellow because it directly says that there was an improving risk sentiment, right? Inverse to that would be something like a deteriorating risk sentiment or a weaker risk sentiment. And we're not seeing that type of vocab words. Then in the sentence back to that, it says the reduction in trade policy tensions. So again, there we have that reduced trade tension vocabulary word that we also saw up here where it says easing in trade tensions. So that's the second time now that they've mentioned this. The reduction in trade policy tensions between the US and China led to an improvement in global economic growth prospects and lifted investor risk sentiment. So those were the first three highlights that I made in this. And this just goes to show that they mentioned that risk sentiment is improving, right? Which is vocab that supports a risk on market mood. After that, more redactions until we get to about midway through this report. And the only key highlight here is that it says many participants noted that the eventual effect of tariffs on inflation could be more limited if trade deals are reached soon. So that again paints the picture that inflationary risks to the upside remain limited as long as trade deals come into fruition in the near term, which it seems like that's what's happening, right? We're seeing trade deals from multiple jurisdictions, and albeit there are still some lingering, most jurisdictions are attempting to cooperate with the United States, albeit they've slightly pushed back the date a little bit. We're not really seeing any bad headlines as of right now, or any headlines that the market is projecting or perceiving as pessimistic that trade deals are not going to come into fruition. So the market then does what? It grips on to the greed narrative. It starts to price in that inflationary risks are well anchored and that trade deals are going to come into fruition, and we're not going to see them have a negative implication on inflation. So I highlighted that. As we continue, back to back, they mention it again, just like they did up here with them mentioning twice, not only risk sentiment improving, but they also mentioned twice easing tensions in trade. They mentioned the same thing here twice. Most participants suggested that higher tariffs or heightened policy uncertainty would weigh on labor demand, and many participants expected a gradual softening of conditions. What is one thing that Jerome Powell had mentioned in his previous FOMC release statement needed to take place for him to want or be comfortable cutting rates? Cooling in the labor market. And so if most participants here are expecting gradual softening conditions, what does that therefore do? Supports the odds of the likelihood of future rate cuts. So I highlighted that in bold. As we continue, it says here, participants observed that uncertainty about the economic outlook had diminished. That is a good positive sentence right there for risk assets. Why? It says right there, uncertainty diminished, right? In previous reports and on previous Zoom calls, we've covered in market downturns that highlighted word uncertainty usually tends to weigh on risk assets. Well, if we see a fundamental report that says uncertainty has diminished, that's positive, right? Participants observed that uncertainty about the economic outlook had diminished amid a reduction in announced and expected tariffs, which appeared to peak in April. I highlighted that in yellow, and had subsequently declined, but the overall uncertainty continued to be elevated, so that it is something that we need to be mindful of. All participants viewed that it is appropriate to maintain the target range for the federal funds rate at 4 1/4% to 4 1/2%. To continue, it says the committee was well positioned to wait for more clarity on the outlook for inflation and economic activity. For some reason, I was like, what does that mean that the committee is well positioned? So I took that over to ChatGPT and I asked ChatGPT, what does it mean when the Federal Reserve Open Market Committee is well positioned to wait for more clarity on the outlook for inflation and economic activity? And ChatGPT verbatim said that when the Fed is well positioned, it is language that implies an openness to adjust easing monetary policy. It does not signal they're looking to tighten monetary policy or hold policy rates for a prolonged period of time. They are in a solid position or well positioned to wait for more clarity. And you can see up here, most participants are expecting gradual softening, which does what? Supports the ideology behind rate cuts. So you can see how the vocab is piecing together a dovish perspective or a perspective from this report that supports future rate cut bets. To continue, it says most participants assessed that some reduction in the target range for the federal funds rate this year would likely be appropriate. That is probably one of the most bullish sentences here because it confirms that most of the Fed speakers support rate cut bets. Noting that upward pressure and inflation from tariffs may be temporary or modest. There again is that key vocabulary that they don't expect inflation to spiral out of control due to tariffs. That medium and long-term inflation expectations had remained well anchored, or that some weakening of economic activity and labor market conditions could occur. So you can see here again, it says weakening labor market. Remember, Jerome Powell had mentioned what do they want to see in order to cut rates? A weaker labor market, a cooler labor market. It is verbatim the same exact terminology that supports the likelihood of rate cuts. A couple of participants also noted that if the data evolved in line with their expectations, they would be open to consider a reduction in the target range for the policy rate as soon as the next meeting. Well, the next meeting is in July, right? So again, this supports the odds and the likelihood. This rhetoric right here supports the odds of a rate cut. Now, I don't think that that's going to happen. They definitely need to see the data. So maybe if we saw weaker unemployment claims this week, weaker unemployment claims next week, coupled with lower CPI and PPI figures, maybe then we could see a surprise rate cut in July, but probably unlikely. I'd say that September or maybe October rate cuts are probably more likely, depending again on the data. As we continue, I think I have one last highlight, and it says here, the assessment that uncertainty had declined. So there again is that key vocab word combined, uncertainty and decline. The other one was uncertainty diminished. This one says uncertainty declined. The assessment that uncertainty had declined reflected in part a reduction in the expected level of tariffs, which appeared to peak in April and had subsequently declined. So yet again, we're seeing that most Fed speakers think that tariff uncertainty is behind us. We're seeing them commit to an openness to possibly cutting rates later on this year, as long as the data supports it. We're seeing them mention that inflationary risks to the upside remain well anchored and aren't really that serious right now, or at least we're not seeing inflation spiral out of control due to the current tariff situation. And we're also seeing terminology like uncertainty, diminished, all of these things paint a picture that allowed for the total cryptocurrency market cap today to do this, which is exactly word for word what we projected we would needed to see in our prior report the day before. We needed to see dovish commentary or the FOMC meeting in minutes hint at rate cuts or at least ease concern over global uncertainty. You guys see that right there. That is probably the most clutch little tiny analysis sentence right there. At least ease concern over global uncertainty and tariffs leading to higher inflation. And that is rainbow scenario what we got today in this FOMC meeting in minutes, right? So now you guys can see moving forward, hopefully how to kind of analyze these reports. If we zoom out and look at how much I redacted out of this report, it's literally like 90% of this report. All this down here is just fluff. But yeah, the vast majority of all this is just a bunch of bullcrap you don't need to pay attention to, which is honestly 99% of the content on the internet, just a bunch of bullcrap you don't really need to pay attention to. Learn how to analyze that by hopefully paying attention to these Zoom calls and the fundamental reports that we type out. And outside of that, this stuff is pretty easy to grasp. So looking into tomorrow, we have the unemployment claims to be mindful of. Heading into Friday, we have Fed speakers to be mindful of. So let's just take a look at the things that could weigh on risk sentiment now that we have an idea on what could be positive and would most likely continue the momentum, propelling risk assets higher. Let's take a look at what could shift the landscape. So tomorrow, if we see any of these things, or even heading into the weekend or next week, we could see the sentiment start to deteriorate and we could see some profit taking in risk assets. Any hawkish surprise in the upcoming labor data, strong jobs or unemployment prints, any Fed speakers shifting tone toward inflationary vigilance or them pushing back on the ideology behind rate cuts, any breakdown in US trade negotiations or new tariffs before August 1st. Now, something that we need to keep in mind is just because some type of tariff headline breaks does not mean it's going to have an impact on the markets. If right now the markets are pricing that the worst case scenario for tariffs is behind us, then really the markets are only going to react to tariff headlines now moving forward if something extremely negative comes out, like a retaliation between the EU and the United States, where they just clash headstrong, they don't come to terms with any agreements, and or tariffs stick a lot higher or implemented a lot higher in terms of percentages than they're currently being priced in right now. That's something that we could see. Japan, the United States, which have not solidified trade negotiations yet, if they clash, Japan escalating and retaliating against the United States, implementing higher tariffs, and then them going back and forth tit for tat, right? We haven't seen any of that yet, but it is something that could weigh on risk sentiment intraday where we could see some profit taking and risk assets if it were to unfold. Any signs of persistent inflation? We don't have inflation data until next week, so that's not something that we need to be worried about. Any resurgence in the Middle East tensions or any military confrontation? That obviously, of course, goes for Russia and Ukraine as well. Right now, there have not been any geopolitical tension headlines as of recent this week, but on the drop of a dime, we could always see flare-ups escalate. And if that does take place, it's most likely going to create more pent-up demand for safe haven and weigh on risk assets. An unanchoring of inflation expectations, particularly in the short term. And then any weakening business investment or consumer sentiment that starts to bring back those inflationary fears. As of right now, however, the vast majority of these fundamentals are holding weight in the market, which we can see reflected in price action. And so as long as nothing changes and we don't see any of these headlines break, then again, just like I mentioned at the beginning of this week when we did our Sunday, Monday analysis, the path of least resistance remains to the upside. But that does not mean that the market is just going to go in one straight line. I know you guys see those freaking XRP projections that are just like this, right? They look like this, and they take snapshots of like 2017 and compare them with current price action. Well, we have to understand that institutions that have, defended previous sell positions here, if we do not see buyers cleanly break with bullish momentum above these levels, we're most likely going to see some resistance. We're going to see sellers try to defend, and that's going to create the price intraday fluctuations that we see in terms of price action that create these intraday legs. So we could see if the market is going to continue to trend up, we could see some new higher lows created. In intraday, this might be slightly painful because this would be a day where $50 billion or so is liquidated from the market. So the market makers can reposition themselves at a discount before setting price higher. This is what realistic price action looks like intraday, not just a straight upwards trajectory, right? So understand the landscape that could be painted moving forward. As of right now, just taking a look at XRP's price action and just doing an overall analysis before we jump off here, before I open the floor for questions. Again, if we do break $2.43, which is our next delta that we need to overcome, where we can clearly see some resistance here, sellers defended heavily at these price levels. I do notice that we tested this level 3 times where buyers were unable to make an attempt to break above. That most likely means that if we do break the $2.43 level, there is no delta until $2.57, which means that if we do break this level, we're probably going to see a nice bullish push, retesting $2.43, and then coming directly up into $2.57 to possibly $2.63 before we see any resistance or sellers try to show their hand and defend at higher prices. So for now, those are going to be our next areas of interest. If the market trend currently holding weight continues, $2.57 to 263, opening the door for higher targets if we do break that 263-cent threshold. Remember, the next delta does not come in until $3.39. That will be our overall bullish target for now, $3.39, if we can overcome the deltas at 257 and 263. If at any point in time the market sentiment sours and we get the inverse of the currently expected market continuation, which I personally think is going to happen, unless we see anything completely deteriorate the current sentiment, then it would be simply just some profit taking at these highs and a possible pullback back down into $2.28 as our first intraday bearish target to possibly reconsider what's going on in the markets at that point in time. If the markets flip even more bearish than that and break $2.28, retesting to the downside with worsening market conditions, that's going to open the door for $2.17 to possibly $2.09 before we recalibrate and do another assessment. But again, for now, it looks like buyers are in control. We have not seen any excessive sell pressure. Buyers are smoothly and cleanly breaking through these sell deltas. You can see here from roughly about $2.17, we went from 217, broke above 228. Markets created a higher low, repositioned themselves. Buyers made another attempt to break. They cleanly broke that and came straight into 236, retested 228 before they rekindled and reorganized themselves, defending 228. They broke smoothly through 228, made their way towards 236. They have now retested 236 with this wick and are now making their way to possibly take over $2.43. So let's see how this continues to unfold. And the total cryptocurrency market cap, same thing. I had identified these premium areas of interest where if the market trend continues and we do break into a new weekly high, we're most likely going to come and make an attempt again at $3.5 trillion or possibly higher. All right. Inversely, if we do start to see market sentiment deteriorate, the first area of interest is going to be this weekly low, which comes in here at about 3.28 trillion. So in a bearish scenario, failure to break higher, sellers defending, the first area of interest before we start to dollar cost average back into the market would be 3.29 trillion. Anything worse than that, we break below 3.29 trillion, we'd be looking at the previous weekly lows coming in at 3.19 trillion before we attempt to make some new dollar cost average positions. But again, like I said, right now, that does not look like the path of least resistance. Seems like the market is still skewed to the upside. All right. Outside of that, that's all that I have for you guys today in terms of fundamentals. I'll leave the floor open for questions if you guys have any. A real solid breakdown and analysis this week. Hopefully you guys have been paying attention, tapping into the Zoom calls. I completely understand that this community can be overwhelming considering the vast amount of information that is delivered on a daily basis. But again, you're coming into a community with individuals that have a combined level of experience of over 20 years. So again, what can you expect, right? But yeah, blessings to you guys. That's all I have for you all for today's breakdown. Hopefully that cleared the air on the FOMC meeting in minutes, helped you guys understand the rhetoric that was delivered from today's report. Outside of that, I'll leave the floor open for questions if you guys have any.